Hello, everybody. This is Dr. Duru of the Market Breadth with Ahan Analytics. Quick disclaimer, what I'm about to describe to you has not mattered for most of the year, but I'm going to keep preaching this message because at some point it will. And even more strangely, what I'm about to describe to you in terms of the breakdown in market breadth this time around, the cycle seems to be brief again, but I was not able to even find any good short-term bearish opportunities. So very, very strange market juncture we're in. So let's dive in. So what you're looking at here is Swing Trade Bot. As many of you know, I have a subscription to this. I'm a big supporter. Some of the features I show in here may not be available for free. This is the stock market recap. And, it seems pretty innocent enough. The S&P 500, Wilshire 5000 flat. The NASDAQ is up and strong. That looks pretty good. But the things start to look a little fishy when you see that the Russell 2000 is down. The short-term trend is down. I ignore the Dow, but you can see it's down as well. Um, and this will give you some of the first indicators of what I'm about to talk about in terms of market breadth. I'm just going to scroll down here. Swing Trade Bot has its own percentage of stocks above their trading above their 50-day moving averages. As you can see, this thing has been going straight down for almost the entire month of December and is now market breadth hasn't been this bad since looks like, yeah, end of October. And this is very strange because if you're reading the headlines, everything looks great in the stock market. The Christmas rally is good to go. Crypto is soaring. AI stocks are still doing well. Now quantum stocks are going nuts. So everything seems pretty fine with the stock market. But under the surface, things have been breaking down. So general portfolios, unless they're overly concentrated, probably don't feel the love that the stock market seems to be giving. This is great. This is a heat map. This just shows what happened today. I won't go into this. There are some individual stories here that I do want to point out very quickly. Apple has been strong, leading the market. It's been up, I think, almost every single day this month. We'll just take a look at the chart later. NVDA has been breaking down. It's actually in a bearish position. So it's part of the breakdown in market breadth of all things. And Tesla is going in the exact opposite direction. Buyers have not had enough of Tesla. So those are the three I'll just talk about really quickly here. But this heat map is very useful for just getting a quick, handy look at what individual stocks. Okay, so let's keep going. And I'm now switching over to Trading View. And what you're looking at here is the market breadth indicator that I like to follow. It's also called the percentage of stocks trading above their 50-day moving averages. And it also shows the same message that Swing Trade Bot did, which is that market breadth has been breaking down for most of the month. It is now at 49%. So 49% of stocks are trading above their 50-day moving averages. Below 50% is definitely at least a yellow warning sign to me, but it hasn't quite hit where it hit in late October. Now, as you can notice, whenever market breadth gets to certain points, at some point the buyers step in and things just soar straight back up. I guess at some point this is going to happen, but if it's going to happen, it's getting kind of late. It's not typical for a Christmas rally to happen so close to Christmas. We do have the Federal Reserve coming tomorrow. Oh, I forgot to mention today is December 17th. The Federal Reserve will be announcing monetary policy decision tomorrow. Typically, I might suggest that that could be a catalyst, but as I write about in my Inflation Watch blog, the Fed is looking at sticky inflation indicators and is not likely to let the market off the hook here and just be outright dovish and say, hey, rate cuts are going to come as you want them. I think instead they're going to start giving some indicators that rate cuts aren't going to come nearly as fast and furious as people would like. And so I can't see the market reacting well to that, but the market has been full of surprises this year, so we'll just have to see. Anyway, the important thing I wanted to mention here is that we have had fades from the overbought threshold. Overbought threshold is 70%. Now let's count this: one, two, three, four, five, 6 times. And this is supposed to be a very bearish event per my what I call my AT50 trading rules. AT50 stands for above the 50. And this time around, I mean, I found plenty of bullish opportunities this entire month, going all the way down on market breadth. So all I could do for my short-term trading call is be neutral and just keep looking out for the opportunities, but they were far and few between. I'm perma bullish on small caps right now, so I didn't go to small caps. And you could see as I go over to IWM, I did miss out on a pretty good short opportunity here because IWM is part of the market breadth breakdown. It's been going down, straight down all month long. And now it's at a very critical test of 50-day moving average support. That's the 50-day moving average right here, this red line. It's uptrending. So as I am want to do, because I am perma bullish on small caps, I bought some call options here, anticipating a bounce. If small caps break down here, though, that will be the next leg of the stool being kicked and leading to a stronger bearish signal. Another one I'm eyeing now for the first time in a very long time is the equal weight S&P 500 index. Equal weight just means that all the stocks are traded equally, all 500 stocks are traded equally. So stocks like the big ones like NVDA, Microsoft, Amazon, and so on, and Apple are not weighted according to how big their market caps are. So they're not having undue influence on this index. So this index is telling you the sort of the average performance of all stocks, regardless of their size. And what this is saying, again, it's confirming the breakdown in market breadth. All this to say, while the indices, particularly tech stocks, look great, underneath the surface, things are breaking down, and we're now at a critical point. Look at the S&P 500 equal weight is now testing the last low in November. So we have important lows being tested, which means that we could already be oversold in the minds of a lot of traders, and there could be a fury of buying starting with the Fed and going into the end of the week. Again, I'm a little suspicious of that expectation, but we'll just have to wait and see. Let's take a quick look at what's going on with the indices. So S&P 500, you could see again, if you were just to look at this major index, you wouldn't think that anything under the surface is weakening. The S&P 500 has just sort of been churning along, right below all-time highs even, and it's still even above the uptrending 20-day moving average. So it looks great. The NASDAQ looks even better. I mean, it's barely off the upper Bollinger Band, which is this black line here, and it's been in a nice uptrend since the last time it tested the 20-day moving average. So nothing looks bad there. So really it's small caps and some percentage of stocks. The equal weight index tells us some percentage of stocks in the S&P 500 are not playing their role. The other thing I like to do sometimes in this case is say, hey, is there any increasing fear in the market at least? And sure enough, the VIX has been rallying generally for the last week or so. And today it had a big 8.1% gain. Now, granted, that's probably just the standard increase in volatility because we have some new uncertainty, a new event that's creating increased perception of uncertainty, and that's going to be the Fed. If that's the case, then we should see the VIX collapse as it usually does after the Fed decision, unless they do something very surprising. So I'm going to be looking to see whether it's worthwhile to buy put options on VXX, which mirrors the VIX. So I'll probably be positioning into that ahead of the Fed in case we get the typical volatility implosion. Okay, so having said that, at the beginning I mentioned there's just been a flurry of action in quantum computing stocks. Now, I am a big fan of quantum computing. I think it is, and actually, I guess now it was the big thing that nobody was paying attention to because AI was so big, and also because quantum computing is still in its infancy, and the breakthroughs are only just now, the really big breakthroughs are just now trickling out. But the current frenzy is what I would say in so many words, just completely out of control. So one of my favorite is IONQ. It has, I mean, what is this? It's gone up 6 times in just 2 months. As you can see, over all time, it's prone to these big spikes. So I have been fortunate enough to play into, I think, a few of these, this one, just maybe about a third of the way up. But then I bailed out when it tested this resistance. I never could have imagined that the hype would get this strong. We have other stocks like quantum computing, perfect name. You can see that it has gone up from basically a penny stock all the way to $16.79, a 51% gain just today. These moves are, I mean, and crazy enough, even though it's gone up that high, it still is not at a new all-time high, which tells you a lot about how much hype there used to be that completely crashed until this latest hype cycle. So my warning is that I don't see anything that tells me this time is any different than the last hype cycles. So I am content to stay on the sidelines and just watch what's happening, use the technicals to identify maybe when the next entry point is, whether it's next week, next month, next summer. I have no idea when the next significant pullback will happen. I'm just pretty sure it will happen. And I, of course, I'm not going to predict from up at what level. But for me, these stocks are just better de-risked when they have pulled back to a decent support level. Another one, quantum mechanic. I keep saying quantum mechanics. That's sorry. That's my mechanical engineering background speaking. Qubits or D-Wave Quantum has also been in the news, and it's got the telltale price action. What's interesting about all of these quantum stocks is while they have been hot and running hot, they actually almost none of these rallies have quite qualified for parabolic run-ups. So the buying has been very orderly. Like Qubits is a great example how a burst up and then a pullback, cool off a little bit, and then the buyers come back in, and then it cools off again. Um, Here, this is consolidation, then another quick burst, and it pulls back. And then here, you can see that people are starting to get recognize this pattern, and we're very quick to jump in. And in just what is this? 3 days, the stock more than doubled. So I'd like to think that this is the beginning of the end. You can see volume went really crazy these last 2 days. So this, what we call a doji, qualifies as a blow off top if the next day sellers come in and gap the stock down. But again, we just have to wait and see. I dare not. There are two things I don't dare do with stocks that are going crazy like this. One is try to call a definitive top. And two is to just jump in without some sort of good stop point or support where I'm entering. And so all of these stocks are just well beyond me. I'm just watching and learning and keeping an eye on things. Anyway, so again, as a summary, on the surface, the market looks good. S&P 500 just floating along, tech stocks doing strong, but under the surface, things don't look good. In fact, they are bearish in terms of my market breadth trading strategy. Small caps have been losing all month. They're testing the 50-day moving average. This needs to hold in order to prevent a further confirmation of bearish action. Market breadth has failed from the overbought threshold again. And so bearish forces, in a sense, have been building, even though they haven't been quite realized. And so this support needs to hold. Otherwise, the bearish tide gains momentum. And then finally, we now have the equal weight S&P 500, which has broken down below a key uptrend with defined by the 50-day moving average, and it's testing important support from November. And I guess it's also key, it's good to note that it's essentially doing another reversal of its post-election, incremental post-election gains. So that makes this move even more important. Finally, on the upside, if support holds, if the sellers lose momentum, if they get exhausted here because of something the Fed does, or if it's just triggered by the Fed in any form or fashion, then all systems go for buying all over again, at least through the end of December. Be careful of what happens in January when people finally want to take profits that will count for the 2025 tax year and not the 2024 um, tax year. Thanks for checking this out. Subscribe to this channel if you want more of this kind of content. Please comment, like, share. All of these things help get this content in front of other people, and also keeps me in the game. Talk to you all later. Thanks.